Hello, everybody, and welcome to the Dorsey Wright podcast for the week of August 16th, 2021. I'm Jay Gragnani, and here joining me this week is Will Gibson. And here we are in the middle of August. It's hard to believe that we've gotten this far in 2021, and Labor Day is right around the corner, just a couple weeks left in the month of August. And so hopefully everybody is enjoying the last days and weeks of summer 2021 as we look forward to September and to Labor Day. But, as we step back and look at the markets today, 2021 has been a relatively calm year as it relates to the equity market, certainly not calm as it relates to political events that are taking place around the world, to just economic events that have unfolded as the world continues to try and reopen and get back to whatever is going to be the new normal following the recent pandemic. And there seemingly is something that's coming out almost every day as it relates to the pandemic, as it relates to the virus, or as it relates to other geopolitical events. Specifically this weekend, we're seeing the news coming out of Afghanistan. And what we have seen, as it relates to the equity market specifically, is just, I think one word to sum it up has been resilience. I mean, if you look at the equity markets really over the course of the past year and a half now, going back to the March 2020 bottom, the market has basically gone straight up. There has been some pullbacks along the way. We'll talk a little bit more about some of the perspective around historical market pullbacks, but you really haven't seen much volatility as it relates to the equity markets over this year, 2021, but really over the course of the past year and a half now. And that shows up, Will, when you start looking at a number of measures. One of those measures certainly being of volatility. That is one of those measures that a lot of people certainly look at is the VIX to gauge some volatility in the market.
Yeah, that's great. And just generally starting out ground floor here, we'd like to note that the volatility and anxiety tend to increase when the market is going down and decrease when the market is rising. I think that's an important point to start with, which is why the VIX is sometimes called your fear index. So consequently, there's a strong inverse relationship between the VIX and a broad market benchmark like your S&P 500. Markets going to all-time highs. Usually there's the saying about markets are quiet at tops. And then when you get sell-offs, tends to be much more choppy. And you can see that on a more sensitive basis on a day-to-day time frame as well. We plot the VIX on our platform under ticker VIX. And I was noting this today, Jay, we were talking about how this was actually heading lower all the way down to about 14.5, which was its lowest level since early 2020, so pre-COVID levels. It was heading down to that level prior to today. We have seen a marginal uptick in your volatility index on the VIX back to 17.5 range, but I would still note that that's below the 10-week trading band, which is just a short-term envelope to measure where price is using the past 50 days. And the point here is that we're still at relatively normalized levels. This isn't something that I was expecting, particularly given the recent headlines today, as well as just a busy lingering effect of earnings and economic data. You would expect to see maybe some more uptick in the market and some more shifting around, but that hasn't been the case. Like you said, I think resiliency has been a great word to describe the market, and not just the S&P 500 by looking at volatility there, but even on the Nasdaq 100 side, looking at a relative respective measurement of volatility, which is VOLQ on our platform. That has not changed. That is actually still near pre-pandemic lows in terms of volatility, down at 15 on its chart. So maybe you could see that that area has been even more resilient lately through some of the market noise, seeking some amount of protection in your large cap growth names. That has certainly been a trend in the past couple of months. But Jay, in aggregate here, it's really surprising to see, maybe encouraging, I could say, that the market has been this resilient and volatility is still at very normalized levels.
Yeah, certainly coming to at a time where we're seemingly every other day getting the S&P 500 hitting new all-time highs. Not certainly not today yet. That this day's not over as we're recording this. But if you just go back historically, I mean, you look at these numbers, and there's a lot of sentiment out there that the market is due for a pullback, it's due for a correction, and that is, certainly just by historical standards, that wouldn't be unprecedented to see. I mean, if you go back and you look at the market, if you look at all the data back to the 1920s, the S&P 500 has pulled back 10% on average about once a year, and we're about a year and a half removed from where we saw that initially hitting the 10% pullback back in February of 2020, ultimately bottoming March 23rd of last year. But even if you look, just since the 2000s, you've seen about 10% pullback. So about once a year, year and a half or so is kind of your typical sweet spot of when you tend to see those 10% pullbacks come in the market. And so from that perspective, a 10% pullback from here would certainly be seen as something that is a very normal occurrence in the market. Now, with that said, what you've also seen too is there have been stretches of 3, 4, 5 years or more between 10% corrections historically. I mean, most recently, you went about 4 years from August 2011 until August of 2016, or excuse me, August 2015, without seeing a 10% correction during that time period. You've been stretches back in the 2003 to early 2008 time period where you did not, so over 5 years, where you did not see a 10% pullback in the market, and the market just continually, steadily plodded along higher. And that certainly is possible. And so, when you go and you look at the market and say, geez, we're due for a 10% pullback, I think you're absolutely right. We are, just given the fact what the market does, but there certainly is historical precedent set to see the market move higher, steadily move forward without seeing a 10% pullback. So this could go on for years. The long and short of that is, as we look out at the market today, we continue to see, a generally strong technical picture from equities, from an absolute perspective, trending perspective, as well as a relative strength perspective in terms of a leadership position. And so U.S. equities continuing to be the top ranked asset class within Dolly, which it has been now for the past year. August 2020 is when we saw equities return to that number one spot after falling out of favor back in the March-April time period of 2020. Move back up to number one in August, and it's remained there ever since. And, that's not to say that we haven't seen rotation within equities. There certainly have been some periods where we've seen small caps actually lead for a bit in the back half of 2020 and the first part of 2021. But, we've seen large caps, we've seen the large caps really come back and take control of the equity leadership ranks in a big way.
Yeah, Jay, I would certainly reiterate the point about sector rotation. If just watching your broad beta benchmarks, this is something that you would come in and see that, maybe not all that much has changed from beginning of the year until now. But we know that's not the case underneath the surface. As you mentioned, some shifts in style preference, some shifts in shifts in size, as well as shifts in sectors. You mentioned some of the Dolly rankings, or on the asset class group scores page. Something I'll like to do is sort the sectors by score direction. So the general improvement or deterioration of the funds within a certain sector at the top of your sector movers right now. So the most improved sectors on your group scores page are real estate, utilities, technology, and agriculture on a more sub basis. So that's an interesting setup to see at the top there. That's not something that you'll commonly see altogether in that regard. Whereas at the other end of the spectrum here, you're going to see the worst sectors or the most deteriorated being precious metals, MLPs, consumer cyclicals down at the bottom, as well as some smaller and micro cap stocks and funds. So that's an interesting setup in the group scores page, speaking to that sector rotation. And maybe on that point, I would say, I think these times are important when you're getting these headlines, when you're having the media say, here are big news events coming up this week, and all of these things that pertain to the market and contain market data. It's important to pay attention to the technical data points, or as opposed to just buying on headlines, selling on headlines, buying on emotion, or qualitative things in and of themselves. And really pay attention to what's happening beneath the market itself. Yeah, I think is an important point to reiterate here.
Yeah, absolutely. And, you've seen, certainly you mentioned some of the styles, and you've seen financials as now the best performing broad economic sector on the year, overtaken energy, which had been the best. But we've seen quite a bit of volatility come back into the energy sector specifically, mostly within the individual stocks. We saw energy fall out of the top half of the Dolly sector rankings earlier last month, back in July, and we've continued to see deterioration there. At the time, the commodities themselves were holding up relatively well, but you've seen, especially in light of some of the news events and events in the Middle East, you've seen crude oil get a bit more volatile, backing off of its mid $70 level in terms of crude oil prices, got up to the mid $70 level, have now backed off, dropping below $70 a barrel here recently, and continuing a bit lower here just today. That, as well as the precious metals, have been spaces within the commodity markets that had been doing okay, but have gotten volatile here recently. So those are just a couple areas to keep an eye on, a couple areas to watch for. At the expense of the weakness in energy with respect to the Dolly sector rankings, the same things you mentioned: financials, real estate, technology. Those are all the sectors that have shown the most improvement here recently over the course of the past couple of months or so, and seeing those areas move up to either among the top sectors like financials and technology, up in the top 3, real estate very close to cracking the top half of those sector rankings. So we'll continue to pay attention to that, continue to pay attention what's going on underneath the surface, and not just the fact that the market is continuing to push to new all-time highs, which certainly has been led in large part by the large cap growth, big technology names that make up a bulk of the weighting in the top 10 names of the universe, are those big large cap growth names. And so, those certainly continue to be important, but we continue to be important to watch for those changes that are taking shape underneath the surface as well. So with that said, Will, appreciate you joining us this week. Thank you all for taking the time to listen to us and hear what we have to say. And if there's anything we can do for you, please don't hesitate to reach out to us. Look forward to talking to you all soon. Thank you.